Lebanon. I mean, one of my immediate concerns was, why are lawyers from Nissan being sent to go to Lebanon to retrieve evidence? These are just lawyers, they're corporate lawyers from Nissan. You had revelations that a number of executives had benefited from share appreciation rights when they shouldn't have. I mean, you know, substantive amounts of money being taken by these guys when they weren't entitled to take them. And you do think, yes, how is this going to look later on? It's going to look quite concerning. So that triggered for me the sort of assessment that, well, I'm going to have to do something, because up until this point, I haven't put down on paper these conflicts and these issues.
So Rav Pasi makes a fateful move. He writes this letter to the board listing every suspicion he has in great detail, backed up by evidence, backed up by memos, of why this internal investigation had serious problems. He sends the letter to the board and it's crickets. He doesn't hear much of anything.
Nothing happened thereafter. Nothing at all. Just like it just gone into a black box.
And he began to suspect that there was a desire, even at the highest level within Nissan, to kind of sweep these conflicts of interest under the rug.
Unfortunately for me, I think, you know, again, with hindsight, people must have thought that this is the nail that's sticking out, and we can't have this. Within 3 days of me submitting that to the board of directors, that letter to the independent board of directors, I was removed from the Going Executive Conduct Matters. I was then told that I could not attend board meetings anymore. And up until that point, I had attended every single board meeting. I was then also told that after 8 years of being in Japan, I'd be going back to the UK. It eventually transpired that I'd be the VP of Projects and Transformation, managing a team of 3. So you can imagine what this feels like at this stage. Almost an arbitrary removal from Japan, where I've lived for 8 years, had 3 children there, my family has grown up, and we've been settled there, having a few months earlier been promoted to vice president at a global level, to being almost demoted.
So Pasi was essentially being reassigned to get him as far away from the internal investigation as possible, and also to a certain extent in retaliation to some of the issues that he brought up regarding the internal investigation and Harinada.
What happened to Rav Pasi can be seen as a series of corporate humiliations. I mean, first of all, his immediate responsibilities were taken away from him. Eventually, he lost, you know, the coveted general counsel title. But it didn't stop there. Toward the end of his stay in Japan, Rav and his wife were convinced that they were being followed.
During that period, I'd noticed that whilst driving my car, I'd have other cars following me. First time I noticed this was around mid-March, and I was driving, I can't remember where I was going, but this grey van, small van, just literally started following me. And I noticed that there was somebody in the car taking pictures. And lo and behold, we were absolutely being followed either by people on foot or other individuals, 2 or 3, normally 2 burly men in a car, different cars at different times, following us around. They were following the family as well. And, you know, given I'd seen the Nissan security department behave in a very, very egregious manner with others in terms of following and surveilling, I was very concerned as to what they were doing and who they were giving this information to. Because if they're giving this information to the authorities, you do think, why? What's going on here? I mean, this is just not normal behavior.
And this all culminated in a rather dramatic event in the middle of 2020.
Who are you people?
Where Nissan had hired a legal team and had obtained an unusual court order from the district court in Yokohama
To basically do a search of his home and seizure of his corporate laptop and phone and other documents.
If you don't let us in now, we have to break this key.
So it's a pretty extreme way to treat someone who'd spent 16 years at the company.
These people have all come in. We don't really know who they are, apart from the fact that I've been shown a badge that says the Yokohama court. And they're here to recover a laptop and a mobile phone. It was even more weird because I'd highlighted to the directors that certain Nissan executives were trying to recover this laptop and this phone whilst I was still in Japan. And I was very concerned because it had evidence on there that related to misconduct matters and other forms of inappropriate conduct. It was just another form of intimidation, another form of harassment, forcing me almost to leave the company and the country. Because once they'd retained and obtained these items, we were still followed, which, again, I just couldn't understand. What is the point of doing that? You know, this isn't a car company. This is not the KGB.
I think it's fair to say that Rav Pasi didn't have full battlefield awareness of all the intrigue going on at Nissan. I mean, Harinata is interesting because he's both charismatic and charming, and one of the most brutal corporate infighters one could ever run across.
This is a confidential company email, right? You should not have this.
If he had fallen into line, he would probably still have his job at Nissan, be paid very well, and continued his work.
A career that he spent 16 years building at Nissan is irretrievably broken. It's been smashed to smithereens. He and his family paid a huge price, certainly. But in terms of being able to sleep at night, I think he's come out ahead.
I highlighted issues to the highest levels of the company so that they could be dealt with appropriately by those in charge. There was no response to those, and there was retaliation against me. What's really profound, like absolutely profound, is that none of your colleagues, I mean people who you have known for years, forget it.
Yeah.
You're on your own.
Yeah.
And you got to be ready for that. You've got to be ready for that. If you take it on anyway.
This is the awful truth. There's always someone in the family that's pushing it.
This lady does not deserve to be taken advantage of, especially at your age with your own grandchild.
Yeah.
My grandma is having to sue them. I'm testifying against them. Nobody's talking. They're one floor below right now. I get afraid to go on the elevator. It's sad that it had to devolve to this.
It's like a soap opera to me.
It's a very sad thing.
It's a family feud.
A family feud.
Here's a family that, on paper, you would think has the wealth that so many people seek, yet at the end of the day, it seemed to sort of rip everybody apart. My name's Tom Schoenberg. I'm a senior reporter here at Bloomberg News, cover financial enforcement. I was approached by someone close to the Schottenstein family and asked whether or not I would be interested in writing about Beverly Schottenstein and this case that she had against J.P. Morgan. And it was immediately clear that there was a great story here to be told. So I started just, assembling all sorts of documents that the family made available to me. That included a diary that Beverly had begun writing when she started having suspicions about what was actually going on with her money. Beverly obtained her wealth from the Schottenstein kind of retail empire that has at times included Big Lots, Value City, American Eagle Outfitters, DSW Shoes. Beverly's husband died, and at which point they sold off their portion of the company, bringing them an enormous amount of wealth in around 1990. Estimates of her wealth were around $90 million. She, for many years, had that pool of money being managed by outside advisors. Her grandsons in the late 2000s had both graduated and were becoming financial advisors. She gave them a little bit to work with, and over time, her grandson, Evan, became the trustee of her entire estate. Managing sort of family money is not a conflict. In fact, some ways in wealth management, it's kind of how you get your start. It's kind of the seed that you need to sort of get going in the business. But Beverly started having suspicions that something was wrong probably in around 2016.
Well, there were suspicious things, but taken separately without everyone talking about their own experiences, it was hard to really put it together.
She had written a check to her caretaker, Dawn, that bounced. So she went down to her local Chase branch to sort of find out what was going on. She wasn't getting paper statements in the mail, so she asked them to print out a number of her statements having to do with her checking account and her credit card account.
So we went to the bank and asked for the statements. And she got a whole year and going through all of them, page by page by page.
And it was there she saw all sorts of charges that she said she didn't authorize or didn't know about.
I was becoming very, very suspicious. I was starting to look in the money part, and that's what bothered me more when I saw that money was going, and I was not a big spender.
Around the same time, Dawn, she starts noticing Beverly's son, who lived in the condominium below her, came up with Evan with a shredder and started grabbing papers in her office area, including some with J.P. Morgan letterhead, and just started sitting at the kitchen table just shredding documents over and over.
Yeah, they came in one morning.
They used to do it in the back.
Through the back door, and they brought the shredder inside. And then they went in the drawers in the office and took out all the papers, and they started doing it. I was very suspicious because I know you don't go around and destroying papers.
Beverly said that they had done this many times before.
That's when she said to me, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day she would write a little at a time.
Around the holidays of 2018, a package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
You know, Beverly started to panic. She got really upset and called, JP Morgan's headquarters in New York and asked for Jamie Dimon. She said she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to JP Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place. The granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the JP Morgan. They're now investigating them. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in JP Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. Over the course of their time with JP Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as JP Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from JP Morgan. They issued an award of about $19 million. I reached out for comment, and JP Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness. From my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. It seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself, but at the end of the day, they did wrong.
It's a painful life lesson. Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it. WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commins is a trader who cut his teeth in the pits in the 80s and 90s. When everyone had a nickname, his was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, hundreds of thousands and millions of dollar trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. They didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his oil and gas pit was described to us as amongst the top 3. In amongst that, was very successful and made very large amounts of money as a young man. But inevitably, mechanization and the arrival of electronic markets was the kind of death knell for the pits. And in 2005, the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commins decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, drinking buddy's son, or they're his own kids' friends from football. They're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. Not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Thaden Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. Anyone that covers markets is going to be surprised about that. You're thinking your BPs of the world or your Glencores, but it's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there have been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil was going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. They are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, as desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37, and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to $700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. And the law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they'd done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had is kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided. The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2,
if you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they've done so well for all of these years, which is they go out, they raise from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work, Nature Conservancy and many others see that the carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in this story, including Disney. They didn't want to be interviewed.
Connection lost.
But they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system. And you end up in sort of a race to the bottom. And that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
the Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
It's a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes! It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial. It'd be like a sports car. Yes. We got up to about 108 miles an hour on that test. And it's a short run. It's about 500 yards or so. And came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was like, is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are like the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But there's people that have the ability, the fortitude to stick it out, to see the game-changing platform here. Those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single supercity economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network that in the end will make it possible to travel, for example, over a whole continent. And take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. In a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure the different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. And I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe.
On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them there and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's been super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $79 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price, it can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen. That actually this pollution-free all the way through the supply chain fuel was now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, it's kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial, it'll never be supplied in the quantities we needed, you know, blah, blah, blah. Now we know, let's take action. It's practical, it's implementable, let's do it now.
Okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, you know, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn the gas. At least they're pumping up carbon and methane into the atmosphere honestly. Well, not that honest because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know which is declining in value.
You don't have enough of it, right, to power the world.
Yes, that's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down. Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the Snam model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, the so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, $600. Today, $100, and we see it going down to $50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia is very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big, big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit. And even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling costs of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there. And we're very interested in working that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick it's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
markets, headlines, and break at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Stocks have now turned negative, erasing gains as investors sort through results from the last of the biggest Wall Street banks. They're also weighing risks to economic growth from central banks hiking rates to combat runaway inflation. The S&P 500 index, lows of the day now down 6, a drop of 0.2%. The Dow is down 30 points, lower by 0.1%. Nasdaq is down 6, a drop there of about 0.1%. 10-year's down 14.30 seconds, 10-year yield 2.96%. We've got the 2-year 3.16% on the yield. Gold up 0.1%. Little changed, up by $1.50 now to $17.09. West Texas Intermediate crude rallying 4.1%, 101.60 for a barrel of West Texas Intermediate crude. Federal Reserve policymakers meet next week amid questions about the size of the next rate move. Could it be 100 basis points? Julie Beal is portfolio manager at Kane Anderson Rudnick Invest.
So I think if we continue to see slightly softer data, you have the option to go to 75 basis points. But if it's worse, 100 basis points is absolutely on the table, and I think we should all be aware of that.
After earnings, Goldman Sachs up now by 1.8%. Bank of America also reported this morning it is up by 0.2%. After the bell today, we will be hearing from IBM. IBM shares lower now by about 0.6%. Sources tell Bloomberg Apple plans to slow hiring and spending growth next year in some divisions to cope with a potential economic downturn. Those sources say the decision stems from a move to be more careful during uncertain times, though it is not a company-wide policy. Apple shares, they're down now by 1.7%. Recapping stocks lower across the board with the S&P down 7, down 0.2. I'm Charlie Pellet. That is a Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Live from the Bloomberg Interactive Brokers studio, we are streaming on YouTube. Yes, folks, it is Monday, July 18, 2022. Stocks were up for a second day and then got that Apple news.
Yeah, Mark Gurman reporting that Apple plans to slow hiring for some teams in 2023, and that put a really dour mood, Carol, on the entire market.
Absolutely, and I keep thinking about Jan Hatzius writing over the last week or so saying, anecdotally, yep, everybody's saying the labor market is strong, but when you keep hearing from companies about either slowing hiring or not doing it or letting go of workers, kind of tells a very different story.
Lots of big macro issues for us to dig through today as well. Earnings, global heat wave, oil up again, that stronger dollar, Carol, too. We've got a lot to get to.
Yeah, we're also going to talk about a most read on how the U.S. is exporting inflation. And in keeping with that, another most read, Gazprom declaring force majeure on several European nat gas buyers. It's not just getting fancy and French. We're going to tell you what this means.
Plus, we keep digging into bank earnings when we get the big ones, wrapping it up today. We got those this morning. And then noted short seller Carsten Block, his life just being upended.
This story is unbelievable. And then we're going to get into some automakers treading very carefully into NFTs and Audi's shift to electric vehicles. First up, though, let's get to the market drivers report. Let's set your Business Week agenda, because it was a certain tone and then that Apple news hit. Kriti Gupta, markets correspondent at Bloomberg, here in our Interactive Broker studio. Gina Martin-Adams, chief equity strategist at Bloomberg Intelligence, on the phone in New Jersey. Kriti, take it away, right? All of a sudden that Apple news hit and bam, stocks went down.
Complete turnaround. And I mean, on the surface, this is a weighting story, and that Apple is, of course, a heavyweight in the tech space. But look under the hood here, because Apple, and I'm going to go back in time 2 years ago, when we were thinking about COVID and we were thinking about what reopenings looked like and what closures looked like, Apple was that proxy for it. Apple stores would close in, say, LA or New York, and the entire market would tank. And the reason for that is because not only is Apple a luxury goods company at the end of the day, so that speaks a lot to disposable income from a fundamental standpoint, but think about their business. You go into the Apple store to get your iPhone fixed or to go look at new products. It has a lot to do with foot traffic as well. So basically, the market kind of uses Apple as perhaps a proxy almost of consumer strength and consumer affordability. And now if you're looking at Apple saying, well, you know what, we're a little worried, we're going to slow down hiring a little bit, that is not a great message, in addition to the fact that it's also a heavyweight in the S&P 500. So double whammy here.
Yeah, Creedy, I also think about sort of the safe haven that people have come to think of Apple.
Yeah.
And if Apple's struggling, then what does that mean for the global macro environment?
Well, this is what we talked about, why the earnings season was so important in terms of what companies were saying about the outlook, what they were doing in terms of CapEx, hiring, and so on. Gina Martin-Adams, come in on this. I feel like this is going to be such a key earnings season.
Oh, yeah. On a number of levels, Carol, you hit on most of the key points there. We've got the dollar that's made this historic run over the course of the last year and change, creating some turmoil in currency, combined with rates that are moving up very, very quickly and expected to continue moving higher, really driving, I think, most of the narrative, on top of the margin story, which has really been a story now for about a year with company margin forecasts just kind of continuing to deteriorate a little bit more, to the point where companies are now starting to cut costs to try to save those margins.
So I guess the question is, Gina, what we look for from these companies as they continue to report earnings. We got some, I would say overall, pretty good news from the banks, at least of the strength of the American consumer. But if companies are looking to cut costs internally, that does end up eating into consumer spending ultimately, because they have to, they're not going to raise wages as much, and they're not going to pay their employees as much, and perhaps they won't be hiring as much. The labor market could go down. Give us an idea of the sort of knock-on effects of that.
Yeah, I think so. The knock-on effects are we get more and more confident, or the probabilities of the U.S. falling into a modest recession increase as the earnings season goes on. But the counter to that is the very typical cyclical progression of events, right? And what really leads stock prices is margins. So when you hear companies are cutting costs, while it's not a good thing necessarily for the company, for the broader economic outlook, and you certainly see that your confidence in the economic outlook deteriorate, it actually is a net improvement for the outlook for stocks, because stocks lead the economy, margins lead the stock market, right? So I think you have to kind of twist your mind around that a little bit, because company earnings are what drive stock prices.
Right.
Company earnings have been deteriorating because margins have been deteriorating. They've got to turn that around for the margin outlook to improve.
I think about that so much, and I think about the forward story. And Creedy, come on in on this. I mean, I've already started talking about like the Fed cutting rates, and I do think about, as Gina pointed out, I feel like companies are very quick when they're under pressure to either slow down on hiring, cut costs, do what they need to protect their margins, and that helps us kind of get to the other side maybe more quickly, although it could be painful for a little while.
Yeah, it absolutely could. And I think what Gina said is crucial here, in that earnings do ultimately drive stock prices, but I'd add an exception to that, and Gina may or may not disagree with me, but I think it's also key to think about when you're talking about recession, when you're talking about panic, and we're talking about kind of theme-based trading, sometimes the fundamentals don't matter here. And then I'm just going to quote the one and only Cameron Christ, who told me early on in my training, sometimes traders trade because they want to trade. And sometimes I think there is a case to be made here that if you are looking at a recession around the world, you're looking at halted gas flows, et cetera, sometimes people will look at the market and say, we don't care about the fundamentals, we just want to go into a country that is safe. And I think those fund flows really matter as well, which brings it back to the dollar story that Gina and you were talking about, right? Because that ends up serving as this massive hurdle.
Well, take a look at, right, Gina, companies like Apple, Microsoft. Microsoft warned, was it back in June, about the impact of the currency effect. We're going to see that play out on some of these big global multinationals.
Oh, yeah, absolutely. And about a third of S&P 500 companies, many of them big bellwethers, do have exposure to the dollar. So you're going to get that short-term impact of dollar strength really impacting earnings through the translation, the currency translation, in particular for those that were not hedged or inappropriately hedged coming into this quarter. It's just been a vicious move in the dollar. Now, I think the bigger story, frankly, is what actually happens with economic growth in those nations. And we just did a report on this today and talking about expectations that are embedded in the prices of stocks with the most direct exposure to revenues coming out of Europe or China. And what we found is investors generally underestimating some potential rebound in China as the country reopens,
right?
But potentially also underestimating the degree to which Europe may slow down. So I do think there's a potential trade emerging there on the pure economic outlook, which is a lot more enduring than the dollar translation effect.
We got to think about it as the global picture. So important. Gina Martin-Adams, thank you so much. Chief Equity Strategist at Bloomberg Intelligence, and always our thanks to Creedy Gupta, Markets Correspondent at Bloomberg.
Let's check on the latest business, world, and national news. Denise Pellegrini is here in the Bloomberg 1130 newsroom in New York. Hey, Denise.
Hey there, Tim. Well, Dr. Anthony Fauci is making plans to retire. Bloomberg's Nathan Hager is tracking developments from Washington.
Arguably the nation's best-known doctor, Fauci has served under 7 presidents as head of the National Institute of Allergy and Infectious Diseases and as chief medical advisor to President Biden. Now, Dr. Fauci tells Politico he will leave by the time this president's term ends, saying if he were to wait till COVID's over, he'd be 105. Dr. Fauci also says he's ready for any political attacks if Republicans take control of the House or Senate. He says that is not a factor in his retirement decision. In Washington, I'm Nathan Hager, Bloomberg Radio.
Thank you, Nathan. And jury selection underway for former Trump advisor Steve Bannon. Bannon facing criminal contempt of Congress charges after refusing to cooperate with the House committee investigating the January 6th Capitol insurrection. England's Prince Harry delivering a keynote address to the United Nations General Assembly. The Duke of Sussex warning the world faces multiple crises, including erosion of freedoms and climate change, saying the world is at a pivotal moment that requires action.
A moment where multiple converging crises have given way to an endless string of injustices. A moment where ordinary people around the world are experiencing extraordinary pain.
And Prince Harry speaking there for Nelson Mandela International Day. And wild story just up on the Bloomberg terminal, COVID vaccine technology could actually help sick honeybees. Greenlight Biosciences is developing an RNA-based syrup to attack varroa mites. That's a parasite that can make the honeybees sick. The RNA prevents the mites from reproducing. Denise Pellegrini, Bloomberg Radio.
Got to watch what's going on with our bees, man. This population, so
You know we have bees here at Bloomberg?
What do you mean?
We have beehives upstairs.
How did you know that?
Because I went up to the 8th floor and I was in a meeting up there and there was a beehive out there. It's so cool.
Are you serious?
And you can sign up to get the honey.
Oh my God.
I know.
How did I
I'll
not
show
know this?
you when our show's over
I've
at
been
5,
here
okay?
forever. How did
I know.
It's always
8th floor. We'll go up there later, Carol.
Employees who steal the
It's
cool
really
stuff.
cool.
All right, I've got 8th floor?
Yeah, 8th floor.
All right, I'm going up there. In the meantime, we got a lot going on here, and we just mentioned we're certainly watching the markets, a very different trade versus what we saw most of the day because of Apple saying it's going to slow some hiring and spending for some of its teams this year. It's a big, important bellwether, so when they say that. In the meantime, our Sonali Basak, who's going to join us shortly with our TV colleagues, has a great story out on the Bloomberg, really talking with some legendary names in the investment space about kind of where we are and what's the next big risk.
When we look at the information from individual companies and industries, we see that there is a labor shortage at all ends. We all know, for example, that right now one of the reasons behind the rise in service inflation has to do with an inadequate number of workers at airports, in hotels, in restaurants, and so on.
And of course, you recognize the dulcet tones of Abby Joseph Cohen, someone who has seen so many different market cycles. Sonali talked with 3 market visionaries, Abby Joseph Cohen, Sam Bankman-Fried, and Ken Moelis, on what they think the next risk is for the markets. And you love these people, I always do, Tim, who have seen so many different market cycles because they tend to be calmer because they understand things can get really out of control, but they also bring incredible wisdom.
Gosh, definitely read this one. Abby Joseph Cohen's comments really sticking out to me, Carol, because she talks about the decline in population and the decline in the workforce and how important it is here in the United States and globally for us to have growth in those areas, because if we don't, then the economy just collapses. I mean, you talk about aging populations in certain areas, look at the economies of those areas.
Look at Japan, right? We all talk about this. And I feel like aging demographics comes up chronically when we take a look at what's going on in the United States. And, you know, you do wonder about the implications when it comes to the economy. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
World headquarters, I'm Charlie Pellet. Apple is dragging shares of big tech peers lower after Bloomberg reported the iPhone maker plans to slow hiring and spending growth next year in some units due to a potential economic downturn. Apple shares down now by 1.5%. The S&P 500 index is down 2 points, a drop of 0.1%. The Dow lower by 3, a drop there of less than 0.1%. Nasdaq little changed, up 7, up by about 0.1%. 10-year yield 2.96%, 2-year yield 3.16%. Spot gold up 0.1%, 17.09 the ounce. That's a Bloomberg Business Flash.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
Master and Tim Stenovec, joined now by our colleagues Carolyn Hyde, Taylor Riggs, and Shanali Bosek. We're walking our Bloomberg audiences across TV, radio, and YouTube through what to watch as we head toward the closing bells. And I don't know about you, Taylor, but man, what a different market tone thanks to that news out of Apple today.
But trying to climb our way back from some of the losses that we had immediately. So, Tim, I see a NASDAQ that goes green.
Yeah, it does, barely, but it was quite a turn that we saw after Mark Gurman published that report that Apple plans to slow hiring into next year. I mean, you think about Apple. This is a company that is so important for us to keep an eye on because it's a good bellwether for the economy, and it's turned into such a safe haven. And when they're concerned, others get concerned.
And when you've got the market capitalization that Apple has, no wonder you tug the broad bid indices lower. Let's look at those indices. The S&P 500 flat, just 2 points lower at the moment, but we had been more than a percentage point higher. That is the effect, the weighting of Apple when we got that breaking news that indeed they will be slowing hiring. Dow Jones Industrial Average, as we see, just turns into the green as we speak, up just less than 1 point at the moment, but still green nevertheless. The Nasdaq tries harder. It is up 10 points on the day, but still has erased most of its gains on the day amid that Apple news. Russell 2000.
Hello, good day, traders. How are you today?
The small caps.
I'm going to place order to sell Bitcoin. If you're looking to trade Bitcoin, here is your chance to enter position, to place an order actually, at 22,013. Okay, I'm placing an order to sell Bitcoin at 22,013. It's just right here. It's quite close to the actual price. So if you want to trade, you still have time to place an order. Then stay with me, and as you know, we close this trade together. Okay. Okay, order placed. Let's see what's going to happen. You still have time, so if you want to trade Bitcoin, this is short position. I open in short position. Please copy this trade and stay with me, okay? I'll see you later, guys.
We'd be talking ourselves, Taylor, into a recession. Mark Zandi, the chief economist at Moody's, says that's a possibility. He's been an economist for more than 3 decades. He spoke to our Bloomberg colleagues, Valdana Hajrik and Mike Regan. Look what he said. He said, quote, I talked to CEOs, CFOs, investors, friends, family. They think we're going into a recession. I've never seen anything like it. I've seen a lot of business cycles. Now, we should note, he does say that when sentiment is so fragile like it is right now, it doesn't take a lot to push us into recession, though he is not quite convinced, Taylor, that we're going to head into one.
Yeah, that's a good point. I do think that there's a lot to be made, Caroline, of talking us into a recession. And you talk about all of these big companies that are slowing hiring, but they're still hiring. They're just slowing the rate of hiring. That still feels like a relatively positive sign. We're not talking about freezing or firings just yet.
Meanwhile, though, there is some signs of weakness in the overall economy that's coming at us at the moment, and that is housing data. We've got it thick and fast this week, and we started today with that sentiment from the home builders, and it was worsening. Look, it dropped off a cliff. We're at 55, worse than all 33 economists that we surveyed saw it coming in at. So home builder sentiment now at a 2-year low. In the depths of COVID was when home builders last felt this negative. 7 straight months. And remember, for the rest of the week, we've got so much more data to really take a check check on the health of the housing market, whether it be starts, whether it be sales, and indeed whether it be those all-important mortgage rates as well, Tim.
Yeah, to what extent are those higher mortgage rates actually eating into people buying those new homes or buying existing homes? We're going to get a lot of that data later this week. But if we look at how quickly those mortgages went up, perhaps they could go down quickly again if we start to see changes in the rates market.
Mortgage rates up, mortgage rates down, housing sentiment low. What is high is what we are seeing in terms of temperatures globally. Check out this map from our markets team. I mean, it is pretty remarkable what we're seeing in the UK, who have had to deal with strikes, soaring inflation, the resignation of its prime minister. But you're looking at temperatures of 100 to 105 degrees Fahrenheit in London. Paris, we're looking at 100 to 105. Munich, 80 to 85. Back here domestically, Caroline, we're looking at some records for some of the places throughout Texas. I think about the stresses on our energy market and so on. And you've seen some stuff firsthand over in the UK.
Yeah, I just flew back yesterday. And the UK isn't as prepared as like New York is. You look at 100, more than 100 degrees. New York can take that in its stride because you've got air conditioning. You've got a cooler subway. You do not have that in the UK. That is why people are not going in, therefore, to the city. That is why they're going to be spending. Of course, that pulls back a bit. This is a dampening effect on the entire economy. But it also then, of course, the negative effects is it affects power making. Right. In Spain and Italy, they can't make hydropower at the moment because the water levels are too low, and then they turn again, once again, to slightly, well, less climate efficient coal sources, let's say.
Climate is certainly a risk, Caroline, and so is the fact that the U.S. is exporting inflation. We think about that in terms of globalization. One person we spoke to about this was Ken Moelis of Moelis & Company. This is what he had to say.
For a few decades, we were able to outsource to the cheapest labor markets. We were able to rely on each other for goods that really, throughout history, and I do think part of this is going back and reading history, most countries would not outsource items that were very important to their well-being, food being one of them, and I think energy being one that's showing up as to be extremely important. What's going to happen now is I think each society is going to have to think about, did I outsource something that I'm not comfortable with?
So many investors there are worried about the next 6 to 12 months, but then you have the longer term here, and clearly risks are rising based on what's happening today.
Based on what's happening today, the energy concerns that continue with Russia, for example, potentially making it more clear that they're not going to be running those gas flows as hopefully easily as Europe was hoping. But overall, we are seeing gas prices up, inflationary pressure still up, but it looks like the Fed, well, our worries about the Fed are less.
All right, lots to cover. We're going to be back in just about 30 minutes from now, live on TV, radio, and YouTube.
broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C., Bloomberg 99.1 to Boston, Bloomberg 106.1 to San Francisco, Bloomberg 960 to the country, Sirius XM Channel 119, and around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, so we kind of have gotten through the big banks, right?
We have the big banks.
The big banks.
A lot of regional banks still to hear
Massive
from.
banks. Yeah.
Big banks are done, though.
And we're seeing them move. We're going to talk about Goldman, but really we're going to hone in on Bank of America.
Yeah, looking forward to Kat Doherty joining us. She's finance reporter for Bloomberg News. First up, though, let's get a check of latest world and national news. Or actually, you know what? Let's get a check of the markets because Charlie Pellet is standing by right now.
Hi, thank you very much. Here's what's going on. Stocks lower across the board. You mentioned some of those bank stocks this morning. Earnings out of Goldman Sachs. Stock is up 1.8% right now. Bank of America up 0.2, and of course, more on BAC coming up in just a moment. The Dow, the S&P, NASDAQ all lower. Lows of the day right now on the S&P 500 index. Stocks erase gains as investors parsed results from the last of the biggest Wall Street banks and weighed risks to economic growth from central banks hiking rates to combat runaway inflation. 10-year yield 2.96%. The 2-year yield 3.16. Right now, we have got the S&P trading lower amid a pullback in big tech. Apple fell after saying it plans to slow hiring and spending for some teams next year to cope with a potential economic downturn. Apple shares down now by 1.6%. Gold up 0.1%, 1709.95 the ounce. West Texas Intermediate crude rallying 5.1%, 102.57 a barrel. Oil resuming trading above $100 after the Saudis declined to make any promises regarding future output increases. Ellen Wald is a senior fellow at the Atlantic Council.
It's very likely that when OPEC meets on August 3rd, that they will push through an increase in their quotas. They've had, kind of the same progress throughout, doing, small increases in their quotas. But that doesn't mean that production will actually increase in a market-moving significant way.
And today, as oil rallies, West Texas Intermediate up 5.1%. Oil stocks are higher. ExxonMobil, for example, up 2.3%. BP up 2.6%. Chevron up 1.6%. EOG Resources up 2.5%. Pioneer Natural up now by 1.4%. Recapping, stocks lower with the S&P down 11, a drop of 0.3. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, another batch of Wall Street big banks reporting today. The news was giving another lift to the trade. We're talking about Goldman Sachs and Bank of America. Thank you, Apple, for bringing the markets down.
Yeah, as we said, well, there's a lot going on, Carol, today.
Yeah.
But let's stick with Bank of America, excuse me, because that's a really important one. We got Catherine Doherty joining us now, finance reporter for Bloomberg News. She's been in since the wee hours of the morning covering these companies, among them Bank of America. She's with us now in the Bloomberg Interactive Broker Studio. So Bank of America is reaping the benefits of a rate rise, but they're also having to pay up for the use of unapproved personal devices. Give us the big takeaway from today's report.
So big takeaway, it's actually reflective in Bank of America and then across Wall Street. We started to see this last week when first Morgan Stanley, JP Morgan were reporting, and then when Wells and Citi came out on Friday, we expected that the focus, which it was today with Bank of America, would be on NII growth. So every time...
You're talking net interest income.
Yes, net interest income. So now that rates have risen, the banks are able to take in... Their lending practices are becoming more profitable. And the estimates across the major banks for Morgan Stanley, Bank of America, JP Morgan, they all exceeded analyst expectations. However, they've been impacted by expenses and fines. So you referenced, it really is particular to Bank of America, and the other banks have either already disclosed a $200 million fine, or they're starting to reference this probe with regulators with regards to device use.
What the heck is this about? Just tell me, because it's like been coming across and we're like, what?
Don't freaking text your friends about what you're doing at work from your mobile device.
It's simply
right? Is that what it is?
The use of personal devices.
Okay,
yes,
so-
your cell phone.
Okay.
And if they're not disclosed or if it's outside of your work phone. This is across all the banks, but we're just starting to see it really be talked about, and that we're expecting a full settlement to come with the big number.
Okay, what's surprising to me is that this is happening in 2022 versus like 2015, right? Because it's not like, people were using, we're talking like WhatsApp, Signal, any messaging service that we use to send messages to one another, right?
This is the same apps.
So why is this an issue now and it wasn't an issue 7 years ago?
But I thought it was also a clampdown following the financial meltdown.
This SEC and the CFTC are both. This is, I think, the closure of it all. They're just really honing in, and it was after Archegos we started to hear it talked about a little bit more. That brought this back into the attention of regulators. So they basically went back to all the banks, saw that it was still a practice they needed to clamp down on, and this is the end result.
Does this also include when you guys talk with folks in the financial community that they can't be talking to you on their cell phones and stuff? What does this encompass?
Who are your sources, Kat?
No, you know what I'm saying? Does that mean too in terms of how they communicate? Because that's an interesting area.
It's full-on communication, but I believe that the communication is with regards to deals that they are working on, and if they're talking to, if it really depends on the party.
Does there have to be a potential for a possible financial payoff, and not payoff, but you know what I mean, benefit or something?
We haven't seen anything come out to say that there's been instances that the regulators are going to point out, but perhaps in the future when a settlement is publicly disclosed and the regulators come out and say this is our findings, that's something we'll be looking for.
It's so funny, Carol, because if you think about just the way, anecdotally, the way that you and I interact, for example, sometimes I'll text you, sometimes I'll send you an IB, sometimes I'll call you on your cell phone.
Right.
And it's like, if we were working at a bank, how might that be different? And we're always talking about the show.
Right, exactly. Couldn't you be having a meeting with somebody and put something on a napkin?
So,
you know what I'm saying? It's interesting. Do people go back to those kinds of ways of communicating? Because it's
you're never gonna capture all communication, right? But I think that the main focus here is, are you communicating on your work devices or your personal devices? And the regulators are concerned that they were seeing more use of the personal devices, that maybe it wasn't even you were doing something bad. They were just seeing that the use was up and that it was work related. It was starting, I believe, with some of these previous, a year ago, 2 years ago, probes that they started to see communication go offline.
Okay, we only have 30 seconds left. What do we learn about the American consumer from Bank of America?
They say the consumer is resilient.
Okay.
Yes.
That's good.
We're printing up "Consumers Are Resilient" T-shirts, right?
Yeah, but do not send messages that the consumer is resilient on your personal device.
I was going to say consumers are resilient, and then you go on the back and you're like, but for how long, right?
Right. No, that's what we're watching for next. This is just the data from this past 3 months, but we'll see what the second half of the year has to bring.
This was fun. Get some sleep. I know. Do you get some sleep tonight?
Yeah,
okay.
I will.
All right. Kat Doherty, she's finance reporter at Bloomberg News. I love our finance team all across Bloomberg, man. They just really pump it out and really give us so much good information. Of course, joining us in our Interactive Brokers studio.
Let's get a check on the latest world and national news. Denise Pellegrini in the Bloomberg 1130 newsroom in New York. Hey, Denise.
Hey there, Tim. And there's also the possibility that hackers could get control of that data as well. And that's something that Democrats are looking at. They're planning to take up a slimmed-down version of a Chinese competitiveness bill this week. Meantime, and Bloomberg government reporter Emily Wilkins is tracking those developments.
Lawmakers were negotiating a much wider package. This one's mostly going to focus on $52 billion in grants and incentives to help increase semiconductors and help more of those semiconductor companies look at the U.S. as a place where they can build their factories and produce their products.
And BGov's Emily Wilkins also says this bill includes restrictions on investing in China and Russia for companies that receive federal assistance. Jury selection underway for former Trump advisor Steve Bannon. Bannon facing criminal contempt of Congress charges. That's after refusing to cooperate with the House committee investigating the January 6th Capitol insurrection. Nicholas Cruz is in a Florida court today for sentencing in the 2018 school shooting at Marjorie Stoneham Douglas High in Florida. Cruz pleaded guilty last year to 17 counts of murder, and prosecutor Mike Sates laying out what he calls aggravating factors to Cruz's crime.
The murders, all 17, were heinous, atrocious, and cruel. All 17 were cold, calculated, and premeditated.
And the sentencing phase will determine if Cruz is sentenced to death or life without parole for the Parkland shooting. It remains one of the most high-profile school shootings in the nation. Dr. Anthony Fauci says he plans to retire by the end of President Biden's current term. Fauci telling CNN, though, he doesn't have a specific date in mind. And Ukraine's First Lady will be addressing Congress, and that's scheduled to happen day after tomorrow. Global News, 24 hours a day. I'm Denise Pellegrini, and this is Bloomberg.
All right, Denise, thank you so much. Denise Pellegrini with World and National News. How did we not talk about J-Lo and Ben Affleck?
I don't know.
How did we not get to this?
I saw this on Twitter maybe last night or this morning.
Come on, you were looking for the
Carol.
wedding. You were looking for the wedding pictures.
Carol was at the wedding.
In Vegas?
Yeah.
I don't think anybody was. It was like, what? Okay. Yeah, we'll maybe talk about that later. What we've got to talk about is the cost of things. Some going up, some going down. Bread. Have you bought any bread lately?
Yeah, but my wife handles the grocery shopping. We have our, how our tasks. I do all the dishes. Okay, I do all the cleaning.
1950s, have you?
Yeah, well.
Or not 1950s.
We do a lot of this online, Carol.
We do too.
We are ordering a lot online.
Well, Leslie Patton, our Kim Chipman, and Andrea Bassi putting a story out about bread at $10 a loaf arises inflation saps demand for basics.
Wow.
People really begin noticing inflation when it shows up on things that they regularly buy. That's why gasoline and milk get so much attention. Add bread to a growing list of basics that are rising in price and crushing consumer sentiment.
I did over the weekend buy a half gallon of milk. Not even at a bodega in the city. It was $5.99 for a half gallon of milk.
Isn't that nuts?
Half gallon. $5.99. Okay, so amid the highest,
$12 for a gallon of milk.
Well, if you were to buy it as a gallon, it would be $12. Yeah, it's crazy.
Thank you for my advanced math.
You're welcome.
That's expensive. Okay,
amid the highest U.S. inflation in 4 decades, bread prices have soared this year, pushing more premium options to an unheard of $10 a loaf and beyond.
Yeah, I mean, this is where we're watching all of the earnings, especially from some of the packaged goods companies, whether it's a Pepsi or a Kraft or so on. Conagra will get you did a great piece for Quick Take on Slim Jims.
Thank you. Yeah, Conagra, the company that owns Slim Jim, is raising prices across the board. They have Duncan Hines, they have a few other brands as well, because this stuff is going up in price, and if it hits margins, it hits margins.
That video, folks, download it or check it out on Quick Take, is I think 100,000, 150,000.
A lot of people watched it, Carol. Thanks.
People like Slim Jim. At the same time, our Bloomberg Intelligence team out with the story that average airfares are falling as more consumers feel inflation's pinch. I wondered when they would start to come down. Now it's time for maybe.
Charlie Pellet told me about a deal he just found. It's like $70 to fly somewhere.
Oh my gosh. All right, more to come. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Session lows for the U.S. stock market. Stocks have erased gains as investors parse results from the last of the biggest Wall Street banks while weighing risks to economic growth from central banks hiking rates to combat runaway inflation. This morning we heard from Goldman Sachs. Goldman Sachs shares are up now by just about 2%. Bank of America up by 0.1%. After the close of trading, we will be hearing from IBM. IBM now down by about 0.8%. S&P lower by 13, drop there of 0.3%. The Dow down 75, down 0.2%. Nasdaq down 35, a decline of 0.3%. 10-years down 12.30 seconds. 10-year yield 2.95%. Spot gold up 0.1%. 17.09 the ounce, while West Texas Intermediate crude is up 5.2%. 102.65 a barrel. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, among the most read on the Bloomberg terminal, it's also a story that will be featured in the upcoming issue of Bloomberg Business Week, which is due out later this week on newsstands. Already, though, as we said, on the Bloomberg terminal and at Bloomberg.com/businessweek. Such a relevant story to our world, Tim. It's about how the U.S. is exporting inflation, and it's probably going to get worse.
Because of the Fed hikes, Carol. Ben Holland writes all about it with our other colleagues, Enda Curran and Alexander Weber. Ben joins us this afternoon. He's economics editor for Bloomberg News. He's on the phone from our Washington, D.C. bureau. Ben, what does it mean when you write that the U.S. is exporting inflation? What does that mean?
Well, so I think it's happening in two ways. So the first thing is that all over the world in the pandemic, you had this kind of change in what people were buying, right? So people weren't buying gym memberships, they weren't buying restaurant meals, they weren't going on vacation so much, they were buying goods. They were buying exercise bikes and TV sets. But this shift was much bigger in the United States than in other countries, and it's lasted for longer. And it's been amplified by the way that some of the big U.S. retailers have been behaving, because we know now that people like Walmart and Target built up huge inventories of stuff. So they were basically buying even more stuff than American consumers wanted to buy, which was already a lot. And because supplies of all these goods, which are traded on global markets, were constrained by COVID, the effect of Americans buying so much of them was to push their prices up for other countries too.
Also joining us, of course, is Joel Weber, editor of Bloomberg Business Week, and he's here in our Interactive Broker studio. Hey, Joel.
Hi. So, Ben, I wanted to ask you, how is this manifesting itself? We've seen what happens when, we get a glut of inventory in America, and if this is getting pushed out, how is it showing up elsewhere?
So it does show up in the inflation numbers in other countries. But if you look at a place like Europe, then, of course, in the headline numbers, this effect is swamped because, the biggest driver of higher inflation is energy and food, a lot of which is a result of the Ukraine war. But you are seeing higher prices of imported goods by comparison with goods that are produced domestically in European countries. And then the new side of it that we're starting to see now, of course, is that the fix to this, this problem, if you want, of very strong American demand is higher American interest rates. Well, that is knocking the dollar much higher. We now have a very, very strong dollar. And that makes the inflation problem for other countries even worse in a way, because it means that stuff they buy from America or stuff that is priced in dollars like oil and other commodities also become more expensive for them.
And I feel like, this is not something that it's a touch and go, Ben, and this is why we continue to see the inflationary problems globally, sticking with us even longer than maybe we had all hoped.
Yeah, I think so, because this is something that could outlast some of the other causes of inflation. So even if European energy and food problems were to sort of magically disappear, or if they were, that inflation was to fade away, this other stuff caused by a strong dollar, for example, might still be around, and it might still keep inflation higher than the central bankers in Europe would be comfortable with.
Okay, so the Fed pretty much going to keep raising rates for a while. So how much worse is this problem going to get, Ben?
I mean, it could potentially get worse. I mean, the caveat, of course, is that, as I said, the headline inflation in places like Europe is really an energy story. But it could be that even when that goes away, that they are still left with a problem, which is caused by, first strong American demand, and then second, the very strong dollar that makes their life harder. And another thing to think about here is that it also makes the job of a central banker harder. Because if you're the Fed, if you're the American central bank, and you think that American inflation is at least partly being caused by strong American demand, well, that's something you can do something about. When you raise interest rates, you'll be addressing that. But it leaves the European Central Bank, for example, in a situation where their inflation is not being caused by European consumers going out and buying lots of stuff, and yet they still feel like they have to raise rates, and the result might be that they just slow their economy down without really doing much to address the root of the problem.
Why did Americans buy stuff at a different rate than other countries during the pandemic, Ben? Look, we know Americans love their stuff. We know we have different lifestyles in terms of the type of houses that we live in and what we have inside those houses. But was it a function of the length of lockdowns or changing demographic patterns here in the U.S.? Is there an explanation for it?
Because we're really good at delivery, Tim.
Sometimes. We're not good at delivery startups.
Well, I think, as you said, part of it is just that the patterns of what people buy are different in different countries to start with before the pandemic. But I think in the pandemic, probably the biggest reason why that shift was bigger and longer lasting in America was that the United States did a bigger fiscal stimulus than European countries, for example. Because it couldn't really have been that the other side of it, the supply stuff, it was harder to do here because more restaurants were closed in Europe than the United States, right? So.
Yeah, it's a really good point. And the difference is, this is why we watch kind of global central bank policy right now. Like the differences that we will see around the world is going to create problems and certainly different investing environments as a result. One of the things I love in your story is you talk about the two economies may have similar rates of inflation. You're talking about Europe and the US, but they have different kinds with major implications, again, for how the banks tackle the problem. But you talk about, the distinction boiling down to how big a share of price pressures is homegrown. And we really need to look at internally where the inflationary pressures are within each country.
Yeah, and what you see when you do look at that, I think, is really reinforces the point that more of it is homegrown in the United States than Europe, and that in a way that makes the job of the Fed easier, I think, compared with the job of other central banks. Because, as I said, if you think that part of your high inflation in America is caused by strong American demand, well, that's something the American central bank can do something about. They can raise interest rates and they can cool down that demand. If you're Europe, and none of your inflation is really being caused by strong European demand, but you still have very high inflation and you want to do something about it and you're worried about expectations getting entrenched, the risk is that you raise interest rates, but all you're really doing is slowing down your own economy and you're not really addressing any of the root causes of high prices.
Did you just say the Fed has it easy? I love that.
They would take it different.
Jay Powell's calling. He has a little problem with that.
Ben, though, you spoke to a lot of interesting people here. Jason Furman at Harvard was one name that jumped out at me, who's an economics professor there. Just wondering, of all the people you spoke to on this one, what really popped for you? What was an insight that you didn't know going in?
I think something that really jumped out at me was what Jason Furman said about the way that the world economy has kind of flipped in the pandemic. So the problem used to be that, there used to be an abundance of goods. There were plenty of goods, and the problem that countries had was to find buyers for those goods, to find demand for it. And so, in that story, the bad guys are countries like Germany, for example, and China, that were running big trade surpluses and sort of piggybacking off of other people's demand. But in the pandemic, this has kind of been flipped because now goods are not abundant. They're scarce. And in that world, the American trade deficit, used to be that the U.S. was the kind of world's consumer of last resort. When America ran a trade deficit, this helped other economies. And now that's kind of been turned on its head.
Yeah.
When America buys a lot more stuff from the rest of the world.
Right. Yeah, it's makes you wonder how it plays out. Jill Weber, Ben Holland, thank you so much. Check this out in the new upcoming issue of Business Week.
to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close. Just 60 minutes left in your training session this Monday. Caroline Hyde, Taylor Riggs, Shonali Basak in the house. Joined now by Carol Massa and Tim Stenovic. We go together, of course, as we always do, across TV, radio, and YouTube to dissect what was a market that powered higher on earnings, on hope, and then quickly Apple put it to bed.
Yeah, what a different tone, right? Because of that Apple news and slowing down in terms of hiring and maybe spending. What's interesting is it dragged down everything, even some of the outperformers. I'm going to go to those Chinese names that trade in the United States. They were up as much as 5.5% earlier in the session, now holding on to about a 2.2% gain. But what's interesting is why the central bank in China injecting additional liquidity into the financial system for the first time since June, really because of that growing mortgage payment boycott and a virus flare-up. So they continue to kind of have a lot of pressures, Tim, and nonetheless, the Chinese central bank there adding some money into the system.
Well, despite a wider pullback, we are still seeing crypto actually higher today. This is the Block Index. That's the ticker BLOCK. These are the CoinShares Blockchain Global Equity Index. Think companies that are in the blockchain space, that are in the crypto space, like miners, fintech players, and more. It is higher right now by a bit over 2.4%. Crypto is up, so companies in the space are higher. Crypto actually reaching its highest levels earlier in the day, Bitcoin that is, specifically, more than 22,000. It's pulled back a little since then, but still highest in more than a month, Caroline.
How much down for the year, Caroline?
Yeah, well, it's all context, isn't it? Not down as much as Netflix's shares are down on the year, I think. But anyway, let's have a look at what's happening across the overall broader benchmarks, because we are lower to the tune of about 0.5% on the S&P 500, and volume's a little bit muted on the day. We're down about 5% in terms of volumes. You're looking at the Nasdaq off by almost 0.6%, shall we say. We're 11,388. The Dow Jones Industrial Average also back again in the red, off by 0.3%, and Russell 2000 actually flipping into the red as well. It's flat, it's less than a point lower, but still the mood music engulfing the small caps too.
Yeah, the mood music among the S&P sectors is also pretty red. You're looking at the healthcare index in the S&P 500 down 1.6%, communication services down 1.1%. You do have a few sectors in the green, and that's energy up more than 2.2%, almost 2.3%. Materials and consumer discretionary also slightly higher on the day, Taylor.
I'm going to take a play out of your playbook, if I could say so here. Take a look at, well, some of the financials. Chanel, I know that you've been all over these. Decent results here. Look, net interest income on B of A was up, rising rates helping that. Goldman seeing trading revenue, bond revenue up a little bit, so those shares react to that. Synchrony Financial, of course, not a big bulge bracket, but more on the lending side. Earnings per share for them actually rose as well. So some of these stocks really trying to cling on to the gains despite the broader index rolling over. Finally, chips is something I wanted to talk about as well, Carol. Our BI analysts have estimated that, well, legislation for more of that onshoring, it's actually more likely than not to maybe happen this year. So some chips getting a boost from that.
Meanwhile, well, the competition for the next UK Prime Minister is heating up as we see some headlines cross about Rishi Sunak and Penny Mordaunt leading the field there. But I look at what's also heating up, and it's the UK's temperature. We're about to go to a guest in London who is doing it even though she sits in 37-degree heat at 8 p.m. at night. But we are seeing just this pressure on overall temperatures. This means a pressure on the economy. It's going to lead to billions of dollars lost in terms of economic productivity, in terms of the energy costs that they have to withstand, and indeed turning once again to dirtier energy types.
Yeah, that's a really good point, right? And I do think about, the stresses and the costs of, as we see temperatures around the globe, really putting pressure on everyone and companies in particular as well. All right, so this plays into the inflationary picture, no doubt about it. And Goldman Sachs Chief Global Equity Strategist Peter Oppenheimer was on Bloomberg TV earlier and made some comments about, in terms of the chronic and static inflationary pressures, sticking around for a while.
The data we got last week suggests that core inflation is still rising well ahead of most people's expectations, and it's pretty broad-based. So I think it's premature to believe that inflation is really going to come down quickly.
All right, again, that's Peter Oppenheimer, Goldman Sachs Chief Global Equity Strategist. And Caroline, you pointed out that map, right? You think about these energy costs, right? And what it's going to cost, the power costs, and also the stresses, Tim, certainly on our grids that we're seeing globally.
It's also stress on the consumer, not just here in the United States, but globally as these prices go up. I go back to Mark Zandi over at Moody's, who said that by his calculation, the consumer consumer still is in a relatively good place, has $7,000 to $8,000 in excess savings, at least as of right now. And by his calculation, is spending about $500 additionally per month due to inflationary pressure. So there is still some runway here, Shonali.
And you have to wonder when that runway starts to roll over. It makes me wonder, there's so much pressure on the Fed, market expectations pointing to bigger rate hikes if there is more inflation, but how much can they control food and energy costs?
Really interesting one note I read this morning from Reynolds Strategy talking about the massive difference, by historical measures, between actual inflation and the break-evens that have really started to roll over despite inflation on a core, well, not a core, maybe a headline year-over-year basis, really still continuing to climb. Typically when that happens, what they're saying is actual inflation rolls over a lot faster. Effectively, the market's leading us so that they think if inflation does indeed come down more than it is, that could be a positive for stocks. We have to get there first, though, and that's a long ways away.
Or maybe the University of Michigan data did hint to that on Friday, the fact that we are seeing in the longer term, well, you and I may be factoring in 2.8% of inflation, but not the in excess of 3% we previously saw. Is it becoming embedded? And what about the global story? Because we've got, of course, the ECB front-running the Federal Reserve. They come out this week with its policy changes. We're not expecting much in terms of policy changes, but once again, hawkish tone, sentiment, trying to drag inflation back, trying to drag inflation out of the mindset of the public, and also having to do something about those peripheral bonds that keep on selling off when they are tackling interest rates.
Right, the inflation expectations, though, globally, right, they definitely will have a damper on things. Those expectations are important. But I'm going to go back to Taylor, some of what you said, and I do think about what we're seeing in terms of the break-evens and what we see in terms of long-term inflationary expectations. The expectations are that, yes, indeed, inflation comes down, but what is the pain that will be felt on individuals and global economies in that process until we get to those lower points?
Probably a lot.
Yeah. And that's what we see playing out. And you wonder how much that $7,000, I think about, if that starts to wear out. Or Caroline, like, look at the Apple story. If we continue to see companies saying, we're not going to hire or we're going to start letting people go, that's going to have a real term cost.
It was Google, Alphabet, the parent company last week, talking about slowing down hiring. We've got, of course, Apple now slowing down hiring. They're not cutting jobs thus far, but I'm sure that we'll start to hear the drip feed effect of what this means for the labor market when we get to the CEO's commentary later in the week.
Gina Martin-Adams telling us at the top of our broadcast, it's all about margin protection, right? And if companies are feeling the pressure, they're going to do what they have to do to protect their margins because they're going to feel penalties if they don't when it comes to their share prices. Exactly. All right, that does it for now. We're going to be back again live on TV, radio, and YouTube. We're going to count you down to the close. Beyond the Bell is our coverage, our simulcast coverage. We'll count you down to the close on this Monday.
You're listening to Bloomberg Business Week with Carol Massar and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, you are listening to Bloomberg Business Week, watching us on YouTube. Carol Massar, Tim Stenovic, live on this Monday, July 18th. A lot of big macro forces at play, certainly, on this Monday.
I want to go back to the heat, Carol, that we're seeing not just here in the United States, but around the world right now. I'm not a huge, I don't watch a ton of sports, but I just go gaga for the Tour de France.
Yeah.
And I've been watching over the last 2 weeks. They're starting week 3. It's a rest day today. Record temperatures for these riders, 101, 102 degrees in the peloton. They're out on the bike, totally exposed to the sun, 4 to 5 hours. And they are just suffering out there. And you see, and there are fires happening too in the countryside at the same time. You see climate change happening on your TV screen.
It's real, folks. And this is kind of, going back to domestic policy and Senator Joe Manchin saying, nope, I'm not doing the buy-in in terms of policies that would help counter climate change here in the United States. But there's a cost. And we talk about this, when will we see the financially material cost on companies? I would argue, many would argue, that you're seeing it already.
Back to the idea of that energy transition, and I put transition in quotes because that transition is certainly going to be a long time, as we're seeing from Europe firing up those coal-fired plants rather than using those nuclear plants that many argue have less an effect on the environment.
We're going to wrap up our show talking a little bit about EVs, in particular with the team over at Audi and also our own Hannah Elliott. But what's interesting is there's some tipping points that we're seeing in major countries, the United States, the European region, China, when it comes to moving into electric vehicles. So, the momentum of this happening seems to be picking up some speed.
You can get those chips for that electric vehicle.
What? Oh, yeah, there is that.
That's the question.
Which goes back to that other big macro story, supply chains.
All right, let's get a check on the latest world and national news. Denise Pellegrini is in the Bloomberg 1130 newsroom here in New York. Hey, Denise.
Yeah, Britain is bracing for record heat. It becomes one of the hottest places on Earth. Forecasts of 105 degrees there. Guys, this would make it hotter than 98% of the planet's surface. President Biden, meantime, hoping for new climate spending. That may be stalled, though, on Capitol Hill, as you mentioned, but activists aren't giving up. Bloomberg's Nathan Hager tracking the story.
Several groups now say they are shifting tack and working to drive change at the state and local level. The head of the group Carbon Tracker says commissions that oversee utilities can influence policy by helping companies implement climate targets. The youth-led Sunrise Movement's planning a Green New Deal for schools to get middle, high school, and college students more involved. Now that talks with Manchin have fallen apart, the political director of Climate Hawks Vote tells Bloomberg News she and others are concerned they've frittered away their best chance to do something on climate at the federal level. In Washington, I'm Nathan Hager, Bloomberg Radio.
Climate on England's Prince Harry's mind, too, as he delivers a keynote address to the UN General Assembly. The Duke boarding the world faces multiple crises, including the erosions of freedoms and climate change.
Right now, the water is rising all around us, in some places, quite literally. So it's more important than ever that we seek a purpose greater than ourselves and get to work.
And Prince Harry speaking there for Nelson Mandela International Day. And Apple is getting slammed with a new lawsuit. This is over Apple Pay, and Apple is being accused by regulators of using its marketing power to fend off rivals or potential rivals of Apple Pay. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Denise Pellegrini, and this is Bloomberg.
All right, Denise, thank you so much. Carol Master along with Tim Stanovic. We've been talking about a lot of things, but certainly front and center, and this is among our most read on the story, about the record temperatures, or it seems to be headed for records over in the UK, but even across Europe. In Paris, we're also talking about Munich, where we are just seeing 100, 105 degrees Fahrenheit, the expectations for the temperatures. The impact, what many would say, is climate change, and we're just seeing the world warm. I think the UK in particular has had the 10 hottest days or 10 hottest years on record since 2002.
And it's relentless day and night. London is set to have its hottest night on record, Carol. Temperatures in the capital remain around 30 degrees Celsius, 86 degrees Fahrenheit for much of Monday evening. That's according to the UK's Met Office. The country is in the midst of its most extreme heat wave with potentially deadly temperatures that are already disrupting transport, businesses, and schools. Now, New Yorkers might hear 86 degrees and think, wait a second, that's what we live with each and every day. But think about air conditioning in many parts of Europe, including in London. It's not standard the same way like it is in many parts of the United States. In fact, I didn't know this before reading about the heat wave going across Europe, but many of London's subway cars, Carol,
are not air conditioned.
And you know, this morning I was like, on my way to the subway, this is probably too much information, but I'm like, you know, it's like a mile walk from my apartment, okay? And I'm like, I'm soaked, right? It's so humid, and I'm like, I can't wait till I get in that subway car, and it's very cool because then I'm gonna be in a comfortable environment, and like the platform is so hot, but the car is like this little oasis.
It's such a contrast. You grew up on the West Coast, I grew up on the East Coast. I gotta say, I did not have central air conditioning. It wasn't until my parents, like later on, we were all out of the house. But it wasn't just, you didn't need it often. There was maybe a week where you were sweltering, and it wasn't a given. My home today, it has central air conditioning because it's so hot. You kind of hit spring, right? And it's just off and running.
My brother in Seattle doesn't have many homes with central air. They had to wait like a year to get it installed because so many people are doing it in these homes that were built in the 1950s and 1960s because it is so much warmer now.
It's a very, very different world. All right, we're going to continue talking about this theme, no doubt about it, right here on Bloomberg. You are listening and watching Bloomberg Business Week, and this is Bloomberg.
Okay, guys, as you can see, we need to cancel order. It just moved a little bit higher, but unfortunately, we didn't fill the order. Okay, and it moved, as you can see, substantially down. So let's wait, let's see what's going to happen with Bitcoin. For time being, please cancel your order and wait for my instruction. I'll speak to you later, guys.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got the Dow, the S&P, NASDAQ all bouncing along the bottom, very close to session lows. Let's head right over to the first word breaking news desk for today's afternoon call. Here is Bill Maloney.
And good afternoon, Charlie. U.S. stocks with a late day fade helped by news from Apple. The Dow's currently down 78 points, was up 356. S&P's dropped 16, NASDAQ is lower by 51. The U.S. 10-year yield at 2.96%. Gold is little changed. Energy is climbing, and Bitcoin is higher by 4%. Among the main 11 S&P sectors, only energy, materials, and consumer discretionary were in the green. And leaders to the upside in the Dow, Goldman Sachs, Dow Inc., and Chevron, while Merck fell 2% and led to the downside. After earnings, Goldman Sachs rose 2%. Bank of America was little changed. And in other news, regarding that Apple news, Apple plans to slow hiring and spending for some teams in 2023. Wrapping things up, IBM reports after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over your Bloomberg type squawk, SQUAWK on your terminal. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie. Charlie Pellet there with a Bloomberg Business News Flash. So let's get to, I think it's safe to say, a major story of our times. And we were highlighting this in our chat with our TV colleagues. Tim and I just talked about it. Global energy markets and stresses, something exacerbated by the Russian war in Ukraine, climate change, and record hot temperatures around the globe, and a slow move to alternative energy. And in keeping with that, Tim, one of our most read stories on the Bloomberg today about Gazprom declaring force majeure on several European nat gas buyers, and a move that may signal it intends to keep supplies capped. So this is tricky.
Yeah, at least 3 buyers, Carol, received a letter dated July 14th. The action applies to supplies delivered over the past month. We've got a great voice on this. Simon Casey is Deputy Managing Editor for Energy and Commodities for Bloomberg News. Simon this afternoon joins us on the phone from New York City. So what does this mean, Simon? Gazprom declaring force majeure. Explain that to us.
Okay, so force majeure is a clause that you declare in a contract, and it's quite common in the commodities and energy world because, for example, if you have an earthquake or an explosion or something, like an act of God almost, you can declare force majeure and you say to the other party, I can't fulfill my side of the deal, so we're going to have to just ignore the contract or suspend deliveries or something like that. What's unusual here is there is no act of God. This is a political situation, as we all know. This stems from shortages of supply, but also the tensions over the invasion of Ukraine by Russia. It's also notable because this force majeure declaration is kind of retroactive. What Gazprom has apparently claimed in this letter to the utilities concerned is that it covers deliveries of gas that were contracted previously going back a month as well as ahead. Now, at least two of the utilities have come forward and said, we don't accept this. This is not acceptable to us. We want Gazprom to adhere to their contract. And really, this should be considered as just another warning shot across the bows from Moscow to Western Europe. It says, we are in control here, and we can indeed turn the spigot off completely if we choose to do so.
God, Simon, it does feel like Russia just kind of tightening the screws here. And I do think about the implications for Europe, who is feeling the pain from the Russian invasion and war in Ukraine when it comes to the global energy markets. They are feeling it front and center. So what does this mean? What are the implications for Europe going forward? Is this something that could ease in the near future, or no? This is just a sign of more pain to come, likely.
I mean, it's impossible to know because, I mean, it's all in the hands of one person, and he sits in the Kremlin in Moscow. But if the force majeure were to go into effect and Gazprom effectively stops supplying these utilities, and if you take it further and they cut off almost all or all of the supply going into Europe, it's quite devastating for the European economy. I mean, we've already seen estimates come out today that the immediate hit to GDP in the EU, it could be 1.5%. That's probably if anything, on the low side. And we're only in summer. That's the point that everyone needs to bear in mind. I mean, I think if you look at the patterns of consumption in Europe compared to North America, there's kind of not as much sort of air conditioning in Europe yet as there is in North America.
We've talked about that, yeah.
Demand is, exactly. So wintertime natural gas demand in Europe, Western Europe, is something in the order, off the top of my head, like sort of 60% higher than it is midsummer. Gives you an idea. We're at the easy part of the cycle of the calendar right now.
That's scary.
Heading into winter, it is scary, yes.
Simon, quick question though. Gazprom, I mean, Russia needs money coming in. Do they easily find another buyer, aka China or someone else, for what they might not be sending to Europe?
They do export to China. Indeed, we reported today that I think their exports to China are up considerably. Having said that, it's not like oil in that it can be sort of easily stored in vast quantities. You have to keep it moving around within a system. And the pipeline, I mean, Russia's the biggest country in the world, so you cannot simply move gas that was just about to go to Western Europe and funnel it all the way across Russia to China. That's just out of the question. So there are limits. They may possibly have to shut in production, but yes, they can export to China, and they are doing so. And there are some other countries where they've been exporting energy to, notably India has been taking quite a bit of Russian oil, and we've seen other countries in South America that have been taking Russian diesel as well. So there are outlets, and oil and gas, Russian oil and gas, continues to flow as it has throughout the war.
Hey, Simon, before we let you go, just in the last minute that we have, we wanted to get your take on just the heat wave that we're seeing, not just in Europe, but also in London as it braces for the hottest night ever. We talked earlier how there are many subway cars in London that don't have air conditioning because it's the oldest transit system around. Give us an idea of some of the economic effects of this heat wave on the country.
I mean, I think if the heat breaks, the last time I looked, I think it might break on Wednesday or possibly Thursday. I think probably will be okay. If it goes on longer than that, or if it returns later this summer, I think you could see economic effects. Yes, I mean, I'm a former Londoner. If anybody who's spent time in London, especially in the summer, will know that it's not really a city equipped or designed to deal with temperatures into the 90s. Most houses, most apartments do not have air conditioning.
Right.
People get by. Schools don't have air conditioning.
Right.
So if you have sustained heat waves at this sort of level, it's unknown, and daily life starts to grind to a halt pretty quickly.
All right, gotta run. Simon Casey, Deputy Managing Editor for Energy and Commodities at Bloomberg News. This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130. To Washington, D.C., Bloomberg 99.1. To Boston, Bloomberg 106.1. To San Francisco, Bloomberg 960. To the country, Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, you are listening and watching Bloomberg Business Week on this Monday. Carol Master, Tim Stenovec, two sides to the market. There's people who go long and believe the market's going to go up, and there are those short sellers who believe it's going to go down.
Yeah, we got a great profile of one of those short sellers coming up in just a couple of minutes. You probably saw this one break Twitter
Well-known
just
short seller,
in the
right?
last couple of days. Yeah, Carson Block. We're looking forward to that conversation with Katya Porchensky in just a minute. First, though, Charlie Pellet, we got less than a half hour to go. What's going on?
Indeed, 28 minutes to go. Stocks lower across the board. The Dow, the S&P, NASDAQ all on the minus side. Sources tell Bloomberg Apple plans to slow hiring and spending growth next year in some divisions to cope with a potential economic downturn. Those sources say the decision stems from a move to be more careful during uncertain times, though it is not a company-wide policy. Apple shares, they're trading lower today, down now by 2%. The S&P is down 27. We're just about, in fact, we are at the lows of the day right now, down 0.7%. NASDAQ is down 80, a drop there also of 0.7%. The Dow is down 176 points, a drop of 0.6%. 10-year yield 2.94%. The 2-year yield 3.13%. Spot gold little change, 17.07 the ounce, while West Texas Intermediate crude is advancing now by 4.7%, 102.17 a barrel. Federal Reserve policymakers meet next week amid questions about whether the next move will be 75 or 100 basis points. Laura Rame is chief economist at FS Investments.
They need to give these rate hikes time to work on the economy and not be so reliant on the models that are really constructed for, prior episodes where we don't have inflation coming from the disruption in supply chains, from all of the unique pandemic-driven inflationary factors.
And again, we've got the 10-year at 2.94%. Goldman Sachs plans to slow hiring and reinstate annual performance reviews as the Wall Street Bank looks to rein in expenses. Goldman reported this morning, shares up now by 1.9%. Also reporting this morning, Bank of America, that stock turning lower. Bank of America down now by 0.1%. Recapping S&P down 30, down 0.8. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
It is indeed. As Charlie mentioned, we've got stocks pretty much at their lows of the session. Well, there's a story we've wanted to bring you since it hit the Bloomberg terminal last week. It's about the noted short seller Carson Block, and I got to say, it's very telling and a very revealing story.
And perhaps that's why, and I mentioned that it, quote unquote, broke Twitter, of course, an expression meaning, when I log into Twitter in the morning and see what people are writing about, this was certainly one of those things. Katya Porchensky is U.S. News legal team reporter for Bloomberg News. She joins us on the phone from New York City. Katya, I want to get to the crazy anecdote in this story that I think, is one that certainly needs to be explained. Yeah. But first off, we're talking about Muddy Waters founder Carson Block. Who is he?
So Carson is a really interesting character on, I wouldn't say he's on Wall Street because he's in Austin, Texas, but he's a short seller, meaning like he's known for putting out bearish reports on companies. And he has delisted, or his reports have gotten 8 companies delisted over the course of his career. He has a legal background, a finance background. He's really well known because he made his name going after Chinese frauds, a space that not many people were looking at, and there were a lot of Chinese frauds, and so he was right about a lot of these. And he's just become really famous in the space over the last 10 years, making his firm, which started as a research shop, now into a hedge fund.
Right, and I feel like he's very well known to the Bloomberg audience. And when he often writes about something or puts out some research, you often see a name move. You mentioned he's been right about a lot of names. Has he been more right than wrong in his trades? Because I feel like when this, Katya, when we talk about a short seller, it feels like everybody gets so nervous, but it's another side of the trade. So bottom line, has he been right in a lot of his research and his calls?
He has, but there's
complicated.
It's complicated, and there's different types of short reports, right? That exist. There are ones that are saying that a company is overvalued, and then there are ones that say this company is a fraud. And what he and his firm do specifically is they really try to go after ones. I mean, they go through a lot. They do a lot of different types of short reports, but they're well known because they pick out frauds, and they have, they do this like forensic analysis, and they go through all this trouble, and they have researchers around the world, and they coordinate with a lot of people. But they've been under a lot of heat lately, and there's a lot of chatter about them and what they do as an institution, and not just them, but in the short market in general, the way they go about doing their work in a more controversial way.
Right. Well, sometimes you do your work under duress. We have to get to how you start off your story. And I feel like it's very telling maybe about who Carson Block is, in that he shared with you a very revealing and very personal story. Do you mind going there in terms of how you kick off your story?
Sure. So we went down to Texas to meet with Carson and get a little bit of an understanding of how he does his work. And because we have written a lot about a DOJ investigation into short sellers, and have reported about Carson being a person and his firm being one of the firms that are being looked at by the Justice Department for potential market manipulation or coordinated trading. We're not exactly sure what precisely the DOJ is looking at this stage, but they've taken an interest in a lot of firms, and Muddy Waters is one of them. So we went down and we wanted to know more about, the wild west of short selling and what goes on there. A lot of these firms aren't, they're a little bit different from the traditional hedge fund managers that we may all be more familiar with. They're more buttoned up or whatever. And these are a lot of independent researchers that sell their work to funds and move markets. So we wanted to know a little bit about what that life was, that world was like, and asked if he had any experience with wrongdoing in that space. CD practices. And he talked very openly about a time that he believes he was front run by, an individual that he suspects leaked his information, the information about an upcoming report. He was on his way to present a short on Tal education at a conference. And on his way on the flight, he saw there was a mysterious interloper in the market building a position that would profit off of him getting up on stage and saying, go short this position. And it was such a stressful moment that a hemorrhoid burst.
Well, he was on the flight.
All right, we're going to have to leave it there, which is a perfect reason that you want to go read the rest of this story, because it's just, I feel like it just gives you an indication of kind of the pressure, the intensity of who this person is. Katya, we got to run. Katya Porzekanski, she's U.S. Legal News team leader. Check this story out on the Bloomberg.
Let's get a check of the latest world and national news. For that, we turn to Denise Pellegrini. Hey, Denise.
All right. Hey, speaking of health news, Dr. Anthony Fauci says he'll retire before the end of President Biden's current term. Biden's chief medical advisor is arguably the most well-known doctor in the nation because of all his COVID briefings. Democrats rallying their base ahead of midterm elections just over 3 months away, and Vice President Kamala Harris is blasting conservative lawmakers over their positions on guns and abortion.
Scenes of ordinary life have been turned into war zones by horrific acts of gun violence. Mass shootings have made America a nation in mourning.
And Harris speaking at the NAACP convention in Atlantic City. J-Lo and Ben Affleck, as you guys were talking about earlier, got married recently. And as we all know, they tried it years ago when they were younger, but never made it to the altar. Larry Hackett is former editor of People magazine. He says the pair has learned since then to control negative media attention by using social media to make their own PR instead of being done to by the media.
You can go to Vegas with your makeup artist, your hair, someone taking some pictures. You then post this on your own newsletter, and you have your own personal People magazine. They've learned that, and they've taken control of this narrative.
And Hackett says Bennifer and others have learned from watching others like the Kardashians control their own fate. And Amazon is launching a major redesign of its Prime Video streaming service. It'll focus more on original content and also include sports navigation. That could be key when Amazon rolls out that exclusive streaming Thursday Night Football this fall. Global News 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts. I'm Denise Pellegrini. This is Bloomberg.
All right, Denise Pellegrini, thank you so much. Denise there with World and National News on this Monday. So a couple of stories that caught our attention here. One has to do with Goldman Sachs planning to slow hiring and reinstate annual performance reviews as the Wall Street Bank looks to rein in expenses. Are we starting to see the competition for talent?
Have the tables turned finally? You and I have been talking about this forever, Carol. The idea that companies just laying out the red carpet for employees, giving them everything they can in order to attract and retain them. But in a labor market that isn't as tight, what changes?
Yeah, exactly. The chief financial officer over at Goldman, Dennis Coleman, saying on a conference call with analysts, given the challenging operating environment, we are closely re-examining all of our forward spending and investment plans to ensure the best use of our resources. We're taking a number of actions to improve our operating efficiency. Specifically, we have made the decision to slow hiring velocity and reduce certain professional fees going forward. All right, go back to, right, folks, you have been staying with us over the last almost 2 hours. Gina Martin-Adams at the top of the show talking specifically about margins when it comes to companies and, that we are seeing, margin protection at any cost to some extent. And whether that means you're slowing hiring, you're not going to, put out the capital expenditures, maybe at the same rate that you were going to do previously, you're going to protect your margin and try and reduce margin compression as much as you can this earnings season.
Okay, so what are some of the ways you can do that when it comes to your staff? Well, the New York-based firm could reduce the pace of replacing staff it loses because of attrition. So if you lose somebody, you don't necessarily rehire them. That's what Dennis Coleman said, the CFO. Also that, as you mentioned, Carol, it plans to reinstate annual performance reviews at the end of the year. That's a practice that it had suspended during the pandemic.
All right, meantime, on the other side of this, Arkatria Dmitrieva saying U.S. teens are flooding back to the labor market this summer, hoping to pocket some extra cash as inflation surges across the country. My daughter, who is working first year out of college, and there's competition for a younger workforce. I see that big time.
Yeah, the data is here. The participation rate for teens in the job market last month increased to the highest of any June since 2009.
And they're only here for a little while.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. 13 minutes to go ahead of the closing bell. Lows of the day right now. Stock optimism evaporates on Apple hiring plans. Stocks have been higher for much of the day. Stocks turn lower after Apple's plans to slow hiring, added to investor worries that the Fed's campaign against inflation will drop the economy into a recession. S&P down 41 now, lower by 1.1%. Again, to be clear, lows of the day. We've got the Dow down 271, down 0.9. NASDAQ down 120, a drop there of 1.1%. Russell 2000 also turning lower, down 0.6%. The NASDAQ 100 index down 1.2%. Bitcoin up 2.3%, 21,424 on Bitcoin. 10-year yield 2.96%. The 2-year yield 3.15%. Spot gold, little change, down less than $1 now to $17.07. West Texas Intermediate crude rallying 4.7%, 102.14 a barrel. Recapping stocks lower, IBM reports after the close of trading. IBM down 1.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. It's 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
This editorial was written by the Bloomberg Editorial Board. Some 5 miles off the coast of war-torn Yemen floats a rusting oil tanker named the Soffer. A skeleton crew maintains the ship, which is steadily corroding and could break apart at any moment. If that happened, it could release more than 1 million barrels of crude oil into the sea. The United Nations has a plan to keep that from happening, but it's struggling to raise $20 million for the first stage of the operation. There's little time to waste. The sea in the area will grow rougher and even more dangerous in a matter of months. In a world awash with looming disasters, it's hard to think of one simpler to avert. The global community cannot afford to miss this opportunity. This editorial was written by the Bloomberg Editorial Board. For more Bloomberg opinion, please go to Bloomberg.com/opinion or OPIN Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
And we've got just about 10.5 minutes left in today's trading session. And as Charlie mentioned, we are at our lows or just off our lows when it comes to the equity trade here with a few minutes to go. Outperformance, though, Tim, we are seeing it in the energy and materials names, bottom of the pack. Healthcare names, they're down about 1.7%.
All right, let's get into it with Chris Zaccarelli, Chief Investment Officer at Independent Advisor Alliance. Chris joins us this afternoon on the phone from Charlotte, North Carolina. Chris, how are you?
Doing well. How about yourself?
We're doing pretty well. Look, we're not debating right now 75 versus 100 basis points because, you know, we're not hearing from Fed speakers, and it does seem like 75 is going to be what it is. Still, though, there's a lot of consternation when it comes to the global macroeconomic environment with energy crisis and playing out in Europe, and, of course, inflation crisis playing out here. How do you see things?
Yeah, I think that's about right. I mean, we're in the Fed quiet period, and 75 basis points looks to be what we're going to see next week. I think that's what everyone was pricing in prior to those really high CPI prints. But if you looked at the Bloomberg implied probability for the Fed rate hikes, to your point, 1% was only for a very short period of time when people had that knee-jerk reaction. But ultimately, we think a lot of the same headwinds are with us right now that we had at the beginning of the year. As far as inflation continues to be a problem, the Fed is going to be raising rates and tightening financial conditions, and you're continuing to have those recession fears. I think today is very illustrative about what's happening in terms of a recession on the horizon.
So if I look at since the beginning of the third quarter, so I'm looking at since the end of June, if I look at the S&P 500, so the big cap names, Chris, your outperformance so far this month has come from consumer discretionary, it's up 5.6%. Information technology, so, we're talking about growth names. They're up more than 3%. Communication services, financials, consumer staples. I mean, it does feel like high-vol stocks are all of a sudden, we're seeing outperformance. You have told us you feel comfortable putting cash to work. Where do you feel comfortable putting cash to work in this market environment, and what seems to be some changes in where we're seeing outperformance?
Well, we've definitely been dollar cost averaging. I don't know that we've been comfortable trying to pick a bottom, but we've absolutely been putting cash to work. We've really tried to just stay with a balanced portfolio. We've been balancing between value and growth. We've been recognizing the fact that with the market down about 20% year to date, that offers value. But we haven't been trying to predict when and if we're going to hit that bottom. We do think a recession is more likely a little farther down the road. We're not quite as worried about recession in 2022 because of the strong consumer spending, and you've seen a little bit of that in the consumer discretionary stocks. I think if you heard a little bit of the Bank of America commentary, they talked about how spending has remained strong.
Right.
But then you have that news out of Apple today about employment, and that's really the other half of the picture. And so we do think that there is a recession more likely in 2023 or 2024.
Okay.
But ultimately, you kind of have to take advantage of the levels that you have at the time you have them.
So I appreciate hearing your macro views here, but I do wonder where ultimately, you got to figure out where to put your clients' money to work. So where do you? You say this balance between value and growth. What more specifically? What sectors? Where are you doing it?
Yeah, so more specifically within the value side of things, we have been adding to some energy names over the last few months. We're looking within oil and gas. We do think having an inflation hedge in the portfolio is important. We've also been looking at some consumer staples in order to make sure that we have some more resilient earnings on the value side. On the growth side, we're looking for those larger tech names, ones that have sold off a lot, potentially could go down farther, but we think have durable businesses. And ultimately, if you have
like Netflix, which has really been beaten up, and we're going to get a check on their results, is that a name that you feel confident enough to play into?
We more stick with probably the larger tech names in terms of like Apple, Amazon, Microsoft, some of the bigger players that have those bigger franchises. Without a doubt, Netflix is a large company, but we view Netflix as both an entertainment and consumer discretionary play, not just a technology play in the typical hardware or software way of thinking.
So Apple, which came out and really brought the market down, our Mark Gurman exclusive about them slowing hiring and maybe where they're going to be investing as they look at the economic outlook, that's down 2%. Is that a buying opportunity in your view?
It all depends on your time horizon. If you have, a 1 to 3 to 5 year time horizon or longer, absolutely. We think Apple at this price is going to provide really good returns going forward. But if you're a trader, you're looking over the next couple weeks, even for this year, it's going to be challenging. Clearly, day by day, as the news comes out, there can be more downside ahead. And if we go into a recession and it's a deeper recession, then most of the stock market is going to go out farther. It's impossible to know on any given day how soon that will happen. And again, if you have a long enough time horizon, we think there are a lot of good companies on sale right now, and I'm sure we're not the only ones thinking that way. But it all depends on your audience, right? If you have short-term traders versus longer-term investors.
When you say there are a lot of companies on sale right now, how are you valuing them? Are you valuing them based on what their earnings are what they said about forward earnings lately? Or are you valuing them, like, how are you getting to that price where you're saying they're a good value?
So for us, we're typically, again, longer-term investors. We're not necessarily going to look at what this quarter's earnings are going to be, what this year is going to be. We're looking more franchise value, so kind of looking over a whole cycle. You find those companies with great franchises. I think Apple and Microsoft are great examples where, yes, cyclically their earnings could be down if we go into a recession. But if you think over the next 5, 10, 20 years, we think it's very likely they'll continue to grow those earnings. So we'd be looking more at earnings over the last, let's say, 5 to 10 years, projecting, through a full business cycle going forward, less so quarter by quarter or even, calendar year.
Where don't you want to be?
So right now, we still think you don't want to be in those speculative names, those ones with either extremely high price-to-earnings ratios or ones without price-to-earnings ratio because there aren't earnings. If we are going to go through a recession...
Do you ever really want to be there, to be quite honest?
In our investment style, no. But I do understand that there's a time for momentum. There's a time for speculation. We think if there ever was a time for that time has passed. You won't see that again until we actually are in recession.
All right, we're going to leave it on that note. Hey, listen, we covered a lot of ground. And when I said, do you ever want to be there? Tim's like, yeah, you know, investors
you
were
did
there.
want to be there, yeah.
That's true.
You wanted to be there until you didn't.
Right, exactly.
The problem is a lot of people don't know when to pull from those,
It's
right?
always in the timing, right? Chris Eccarelli, thank you so much. Chief Investment Officer at Independent Advisor Alliance, joining us on the phone from Charlotte, North Carolina. And we say this with just a few minutes left in today's trading session. We're bouncing off our lows, but we're not too far from it. And it's definitely a different tone from what we saw earlier in the day, Tim.
Yeah, it was like the before the Mark Gurman Apple scoop and after the Mark Gurman Apple scoop. That's how we can look at today's trade. They're the before times and the after times. And certainly it's the after times now.
What's key is Mark Gurman's scoop, and Mark Gurman is ours.
That's true.
All right, folks. It is time to head over to our Bloomberg TV team for Beyond the Bell, our cross-platform coverage, live on Bloomberg Radio, Bloomberg TV, and YouTube. We are counting you down to the closing bell on this Monday. And again, as I mentioned, stocks just coming off their lows.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
2 minutes away from the end of the trading day. Caroline High and Taylor Riggs, Shanali Basak counting you down to the closing bell, here to help us